watching Market Cafe on ET Now with me, Shreyansi Singh and Snehi Shah. And over the next 1 hour, we'll get you updates from within the country as well as across the globe. Also tell you which stocks you should be keeping on your radar. And speaking of stocks, then let's take a quick look then at what the Wall Street was doing yesterday, Snehi.
Absolutely, lots to watch out for in terms of Wall Street. You had the big FOMC rate outcome coming in for us last night. It was looking rather mixed if you take a look at Wall Street, but largely it was negative. And US stock futures rose last night as well when Wall Street digested recent quarterly results from a slew of mega cap tech companies. Investors are also coming off a losing session after the Fed Reserve held steady on its rates. Now, when we talk about these tech companies, it's in the likes of Meta, Tesla, Microsoft, IBM. We'll be taking you through their earnings and telling you how their stock has performed in yesterday's trade in detail just in a short while from here. But other than these names, also the Magnificent 7 names are set to report in the coming days, with Apple's results being due for a Thursday release. You have Amazon also that will soon follow suit as the mega cap tech company reports its earnings next week. Now, if you take a look at what the intraday moves were like on Wall Street, on Wednesday, all three major averages ended the session lower as a 4% decline in Nvidia weighed on the entire market. Now, this decline comes after the Fed paused its interest rate cutting campaign, leaving its borrowing rate unchanged. We'll be telling you more about this later as well. In their post-meeting statement, policymakers noted that inflation remains somewhat elevated. So on the back of that, you had Dow Jones trading with a cut of 0.3%. S&P 500 almost 0.5% cut coming in. Nasdaq also 0.5% cut, a 100-point cut coming in on Nasdaq in yesterday's trading session. If you take a look at what's expected from the US market today on the economic data front, the fourth quarter GDP reading is due and weekly jobless claims are out in the morning as well. Investors will also be looking ahead to Friday's personal consumption expenditure price index report for December. Remember, this is the Fed's preferred gauge to understand what the inflation level is like in the economy. So lots to watch out for when it comes to the US markets. But well, yes, the tech earnings on one side and the FOMC outcome on the other side were the two big triggers for the US market last evening.
Well, absolutely. And with that, let's also take a very quick look at what oil and gold then were doing. Firstly, when you take a look at oil prices, it's been a bumpy ride as far as oil is concerned for 2025. A continuation of that is something that we saw coming in. You do have the US benchmark that settled at its lowest year to date after domestic crude stockpiles then in the world's top petroleum producer and consumer rose more than expected last week. That was an important data set that we had been watching out for. So the impact of that was very clearly visible on prices. When you take a look at Brent crude, settled down 91 cents or 1.2%. $76 per barrel is the kind of level that you're looking at as far as Brent is concerned. Even when you take a look at US WTI, then that is also the one that fell 1.6%. $72 per barrel is the level that you're seeing lowest settlement price so far this year, like I mentioned. And you did have crude oil stockpiles. That is something that we'd been watching out for. 3.46 million barrels last week was the kind of uptick that you saw coming in as far as that data was concerned, according to the EIA. And let's also take a look at gold prices because they also slipped on the back of the dollar and yields also rising. So that is something that we were looking at in terms of gold. 0.4% downtick is what you're seeing. So that largely is the kind of handover that we have coming in, a weak one for oil as well as gold, Snehi.
Absolutely. Lots happening on that front as well. The commodities are also in action. On that note, let's take stock of all the important events you need to be watching out for in today's trading session. Now, back home, it's the last Thursday of the month, which makes today the weekly as well as the monthly Nifty expiry. So watch out for any volatility that we're seeing. You have implied open already at 23,142. Not much penciled in for us, but it's unlikely that this expiry could be as flat as what the implied open is expecting. So, well, we'll just wait and watch what today's trading session pans out to be like. But overseas from the US, you have GDP data coming out, like we told you, as well as jobless claims. Shifting focus to what Europe is going to be up to today, the ECB rate decision will be out today. Remember, FOMC and ECB usually go hand in hand when they come out with their decision. We've already heard from the FOMC. ECB rate decision is going to be under focus, in focus next. Also from Eurozone, you have consumer confidence as well as unemployment as well as the GDP data also coming from Eurozone. So along with US, this Eurozone GDP data is also going to be key to watch out for. In terms of some global earnings today, Apple, Deutsche Bank and Shell are going to be some companies in focus. But when you talk about earnings back home, you have 6 nifty companies that will be coming out with their Q3 numbers: Bajaj Finserv, Bharat Electronics, L&T, Adani Ports, Adani Enterprises, as well as Tata Consumer. And well, in terms of some corporate action, then it's the last day to buy shares of Coal India, IEX, Persistent Systems, as well as Shriram Finance to be eligible for their interim dividend, to make it in time for their record date for the interim dividend if you wish to do so. So watch out for all of these cues in today's trade.
Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. With our policy stance significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. I'm not going to have any response or comment whatsoever on what the President said. It's not appropriate for me to do so. Let's say that the unemployment, that the labor market is at a sustainable level. It's not overheated anymore. We don't think we need it to cool off anymore.
All right, then that was the word coming in from Jerome Powell. But let's also take a look at what the Federal Reserve then did. They've left rates unchanged. Chairman also said that the central bank is in no rush to cut them again until inflation and labor market data made it seem appropriate. In fact, a rather hawkish Powell in his policy statement said that the central bank stance is well calibrated at this point and they're not in a hurry to be adjusting the stance just yet, even as data from the labor market then points towards stability. In fact, issues of elevated inflation continue to stick out like a sore thumb for the policymakers, but an outcome that is largely on expected lines. So no surprises there. However, here on, it'll be key to note the quantum of the rate cuts that are yet to come, with policymakers also looking at maybe 2/4 percentage point cuts over the course of the year then.
Okay, so while all of the focus was on the FOMC outcome last evening, you also had a whole slew of tech companies that came out with their numbers, and a barrage of those earnings is what dictated moves on Wall Street last evening, because you had Tesla that delivered a miss on their quarter four earnings and revenue. Revenues were up a meager 2% versus the same time last year, while the company's automotive revenue fell 8%. Operating income too slumped 23% on an annualized basis, and management has in fact cited price cuts across its Model 3, Model Y, Model S as well as Model X cars as a key trigger for the miss.
Alright, then meanwhile, shares of Microsoft slipped as much as 5% in after-hours trade on the back of earnings. Despite an overall beat, growth in their Azure cloud segment was lesser than expected. In fact, the company also gave a disappointing quarterly revenue forecast. And remember, revenue was up 12% year over year. That's the slowest growth coming in since mid-2023.
Well, let's keep it going with earnings. However, on the flip side, things were looking good for Facebook parent Meta, because that reported a beat on both top and bottom lines in quarter four. Key commentary from CEO Zuckerberg saying he expects 2025 to redefine the company's relationships with governments. Sales in the fourth quarter jumped 21% year on year, while net income grew 49% to $20.8 billion as well, up from $14 billion a year earlier. On the AI front, the company reiterated Friday's announcement that it would invest between $60 and $65 billion in capital expenditures in this year going ahead.
Alright, then finally, IBM fourth quarter earnings topped Wall Street expectations for earnings and revenue. Shares rose as much as 10% in extended trading before giving up gains and settling at 9%. In fact, the company said that it expects full year growth adjusted for currency of about 5% and $13.5 billion in free cash flow in this year as well. Their software segment grew 10% on a year-on-year basis, partially due to demand for AI as well as strong performance from its Red Hat Linux operating system.
Okay, while that was a wrap on all the global news and headlines, let's shift focus back home and onto some somber news then, because over 24 hours after the tragic stampede at Mahakumbh, UP's top cops have confirmed that so far 30 devotees have been killed and 60 people are injured. UP Chief Minister Yogi Adityanath has confirmed 3-member judicial probe and has also announced rupees 25 lakh ex gratia for the kin of the deceased. Remember, the Amrit Snan, the traditional bathing ritual of Akharas that was deferred due to the stampede, was resumed and completed in the evening.
Well, that's somber news indeed, and we'll try and get you more updates as and when they unfold. But then time for a very quick breather on the show. When we come back, we'll get you an update on what the Asian markets are up to.
Hi there, welcome back to Market Cafe. Let's take stock of what the Asian markets are up to, starting with Australia. Australian markets have climbed this morning and, well, they continue to rise, a 0.5% uptick coming in. They're breaking ranks with Wall Street that fell overnight as the Fed Reserve kept interest rates unchanged. Now, several Asia-Pacific markets are closed for the Lunar New Year holiday, the likes of China, Hong Kong, Singapore and South Korea. But coming back to what Australia is up to, the S&P, which is their ASX 200, rose 0.3%, extending gains from the previous session and continues to build onto those gains. This is on the back of some data that we're getting from Australia, because Australia's export price index climbed 3.6% in the fourth quarter but fell 8.6% on a year-on-year basis. This is the data coming in from the Australian Bureau of Statistics. Its import price index rose 0.2% in the same quarter but fell 1.9% through the year. These indices reflect the change in prices of imports and the exports from the country. So on the back of that, this index is up 0.5% as we speak. However, on the flip side, Japan is not doing all that much, because Nikkei fell 0.1% on open, has managed to come over to the green, but it's very nominally over there. So very flattish moves coming in from Nikkei also right now. Well, your other markets, the likes of China, Hong Kong, Singapore, South Korea, are all celebrating the Lunar New Year, which is why these markets are closed in trade. But coming back home, if you take a look at what our Nifty has done in yesterday's trading session, 23,142 is where we managed to close yesterday. Implied open at 23,150. So on the spot, it's just an 8-point uptick. That's what's expected for us. Very flattish open is what is expected for us. But given that today is the weekly as well as the monthly expiry, we've always been in store for some volatility on a day like this. And this seems to be a little bit deceiving right now, if you could call it that. But, well, yes, we're at least expected to open slightly higher, very marginally higher than where we closed yesterday. But as we approach this year's union budget, let's turn our attention to the healthcare sector and what experts are expecting. Shuchi Ray, the partner at Deloitte India, anticipates that the government will take steps to boost healthcare demand and introduce tax incentives for R&D centers. Meanwhile, Mohan Nusetti from Lupin hopes the government will increase healthcare spending, implement tax SOPs for R&D and incentivize domestic manufacturing. Let's go across and listen in.
But for the Indian headquartered companies, it is important that there are certain R&D incentives which should be there in the tax. One most important one, which was already there in the Act, was the weighted deduction of R&D. And the second is expanding the patent box regime, which is there for the global sales of the R&D or the products that they develop using their own R&D. Now, these two aspects will automatically increase and foster their efforts towards the R&D in India. But there are fine prints which are yet to come, and it is important that this particular aspect of this sector, which is research and development, that's given due weightage and recognition in this budget. The second one which I will pick up is on the production and manufacturing side. India has always been considered as a good manufacturing location, but I think it is important that now we make it a demand location. Now, how can really it happen? I think it's if I look at it backward working, it's having more and more hospital infrastructure and expanding the medical education. These two things will automatically take care of the demand creation and consequent supply. But this particular demand creation will ensure that there is an availability and affordability, and there is a remote access of the facilities. But at the same time, it becomes lucrative for the companies to invest in the sector.
From a healthcare and life science industry's perspective, I have three key recommendations or expectations from the Finance Budget 2025. The first one is in terms of increased healthcare spending. To achieve the country's Viksit Bharat aspirations by 2047, it is important that we have a much more healthier and a more productive population. It is expected that the budget would move up the needle in terms of spending on healthcare from the present 1.9% of GDP to at least 2.5% of GDP. This would in turn translate to better infrastructure and improved access to quality healthcare, particularly in underserved areas. The second expectation is in terms of incentivizing innovation and R&D. India has a marked advantage in terms of having a strong intellectual pool of resources who contribute significantly in pharmaceutical R&D processes. However, the R&D process itself is very long and very expensive. So extending additional tax deductions for R&D expenditure would go a long way in achieving the aspiration of reaching a $130 billion market by 2030. By providing additional tax deductions for R&D, the government would actually encourage companies to invest in new and innovative solutions, which would in turn drive growth and competitiveness in the industry. Also, additional tax deduction should be considered for training and skill development, ensuring that the workforce is equipped with the necessary skills to support the industry's growth. The third expectation is in terms of incentivizing domestic manufacturing. The production-linked incentive, or the PLI scheme for pharmaceutical products, has successfully boosted manufacturing and enhanced export competitiveness. However, the scheme should be made more flexible to cover a larger skew of products, which would in turn drive economic growth and create more job opportunities.
All right, then.
Hi there, welcome back to Market Cafe. You're watching ET now. Let's get it going with all stock-specific action now and all the earnings that are in focus. It's been a weak quarter coming in for Tata. A weak quarter three. Profits slid by 21%, led by shrinking JLR margins. Now remember, it's Nifty peer Maruti Suzuki also reported numbers during market hours, and much like those earnings, Tata Motors has also reported a miss in its bottom line numbers because PAT has declined by almost 22% in quarter three on a year-on-year basis. EBITDA margin also narrowed to 11.5% from same time last fiscal. If we shift focus to the JLR division, EBIT margins came in at 9%, which is the highest in 10 years. It was also the 9th consecutive quarter of profits for the company. Let's also understand what the management had to say in their con call. They're expecting the demerger to happen by October 2025. They're seeing good volume pickup coming in sales with respect to the US and UK market. So the international market, at least in these two countries, is looking robust for the company. They did receive some PLI incentives in this quarter, so that is something that has worked out well for the company. But they are currently seeing pressure with some of the run-out models of Jaguar, and volume uptick and better product mix will help them achieve the EBIT margin guidance, is something that we have heard from the management. If you take a look at their outlook for JLR, management has cut the FY25 revenue target from 30 billion Great Britain pounds to 29 billion. So that is something to watch out for. The return on capital invested for FY25 is expected to be low at 20% compared to 22%. An EBIT margin target of more than 8.5% and free cash flow target of 1.3 billion British pounds has been maintained. So at least that is looking steady on the JLR front. But let's also go across and listen in to what the management had to say on their outlook for JLR going ahead.
Q4 for us is seasonally the strongest quarter that we have, and we also have almost 12 plus weeks of clean production available for us to sell our cars. So we do expect volumes to continue to improve. That's the reason we signaled that in the outlook as well. Q4 volumes will be higher than Q3, and that's what's giving us the confidence to deliver the 8.5% as well as the going net debt free in JLR. We believe that the intervention that we've been making in the Chinese market is helping us do better than the industry. But having said that, it's also fair to say that the market as such overall, for various reasons, particularly the retailer situation that is there, is under stress. But as far as our recovery is concerned, we do see good uptake coming from the US. We do see good volume pickup coming through in the UK as well. So and the rest of the world, particularly Middle East, India, all of them are contributing a little bit to the overall growth plan. So that's why we believe we are well hedged with respect to managing the China risk from getting volumes from other places.
All right, then that was the word coming in from the management at Tata Motors. But let's get you some more news and updates. Then the cabinet has gone ahead and given an approval to revise rates regarding ethanol pricing, also regularized incentives on production and supply for the sugar year 2024 to 25. Let's also go across to Prakash, who's then standing by with more details on this. Prakash.
The Indian cabinet has taken two important decisions. And of course, the first one is with regard to ethanol prices, where the cabinet has given its nod to the proposal to make some revision in prices of ethanol for ethanol supply year 2024-25. as per the information provided by the government, the cabinet has decided to increase price of ethanol produced from C-heavy molasses by rupees 1.69 per litre. Importantly, the hike has been made beyond the incentives amount, which was rupees 6.87 per litre, which was announced by the oil marketing companies for ethanol supply at 2023-24. Essentially, the Indian cabinet has decided to regularize the incentives amount for ethanol supply year 2024-25, and that will be along with some hike of rupees 1.87 per litre. A very significant development coming in. However, prices of ethanol being produced from bee-heavy molasses and sugarcane juice have been kept unchanged for ethanol supply year 2024-25. Technically, the cabinet has decided to go against the ministry's proposal to make some upward revision of ethanol prices for ethanol supply year 2024-25 when it comes to ethanol being produced from bee-heavy molasses and sugarcane juice. In a second important decision, the cabinet has decided to approve National Critical Mineral Mission with an overall outlay of rupees 16,300 crore. The government aims to create strategic reserves of critical minerals, including lithium, to meet domestic requirement.
Okay, Prakash, thanks so much for taking us through updates coming in on from the cabinet meet on the ethanol front. A bunch of sugar counters could be in focus today on the back of that development. But with the budget just around the corner, we spoke to FICCI on what their key recommendations are for the budget which is upcoming now just a few days to go. The panel touched upon topics ranging from simplification of tax structure to addressing challenges of private investments and consumption. Now with this, FICCI also expects a 15% increase in capital expenditure. Let's go across and listen in.
So I think India's story continues to be very strong in the long term. Yes, in the last 3 months, there has been a slowdown. There is some challenges on consumption as well as private investments. But I do believe that this will get corrected over the long term. We are finding capacity utilization rates to be fairly stable at this point of time. And as that continuously increases, I think we will see private investment also going up. Our recommendations in the budget have been in the interim to spur consumption. And the few areas that we focused on is simplification of tax structures to put some money in the hands of the middle and lower middle income class, to continue on the various schemes of Manrega and Gram Sadak Yojana and other schemes that are there. We also gave a recommendation of issuance of temporary e-vouchers to spur consumption, which have an expiry date so that initial consumption goes up. With that, we believe private investment will increase over time and should kickstart the economy further to higher levels of growth.
Right, Mr. Goenka, let me take the point about consumption, that consumption slowdown and the need to boost consumption in the country. And let me take that across to Mr. Vijay Shankar. Mr. Shankar, now this has been a big challenge to spur the growth of the Indian economy, as has been rightly pointed out several times, which is a consumption slowdown. There is softness in consumption. And that's been a key talking point as far as FICCI's recommendations are concerned, as mentioned in the pre-budget survey. How do you think the government could look at boosting consumption? Are you expecting an easing of taxes, or there could be more boost for the rural economy, or are you expecting more SOPs to boost consumption in the country?
Yes, so three parts to this. One is, as Mr. Goenka spoke about, temporary issuance of consumption vouchers is one of our key recommendations. The second is around the rationalization of the tax structure, both direct and indirect taxes, with a view to put more money in the consumer's hands. I think an increase in disposable income in the coming year in the hands of consumers will certainly give a boost to the consumption demand, which is much needed. The third is around food inflation, which has been a little high. I think what we have suggested from FICCI is that a food inflation response strategy team be set up to address issue of food inflation across the board. What are the causes? Can there be an e-enabled platform which addresses this, creates better information exchange across the agricultural system, which is still a very, very big part of the economy. So we think that if the government focuses on some of these areas, including many of which it has started up on the journey a few years ago, I think it will certainly help boost consumption, which we think is going to be key in the coming year.
All right, Mr. Sankar, let me take the point across to you, Mr. Agarwal. Now, rationalization of taxes or addition of a new slab is something that's being spoken about. What do you think? Could we be in for a surprise with respect to rationalization of taxes is concerned?
See, we all know that government is very concerned about the overall, the challenges related to the consumption, and how do we take steps, so that it will give more disposable income in the hands of the consumers, so that the discretionary spend also increases. And from that perspective, certainly, relooking at the tax rate and structures of the tax is maybe one of a good thing. And we are hopeful that, we might see something in that regard, in the coming budget.
Alright, there you have it. So that's what makes it to Ficki's budget wish list then. But time for a very quick breather on the show. When we come back, more stock specific news on the other side. So don't go anywhere. Welcome back. Thank you so much for staying tuned in. Well, as promised, let's get a little stock specific then. In fact, let's get to the list of stocks that you should be keeping on your radar bright and early this morning. And we have Ria standing by with just that list.
Yes, good morning. We have a whole host of companies reporting their Q3 numbers today. First up is Blue Star reporting quite a good set of numbers. The revenue has gone up by over 25% on a year-on-year basis. Even the net profit has gone up by almost 32%, and the EBITDA has seen an increase of almost 35% over the previous year. Even on the margin front, we've seen quite a good expansion of 54 basis points. It has come in at 7.5% in this quarter. Its competitor Voltas has also reported a good set of numbers. The revenue has gone up by more than 18% on a year-on-year basis, and this time around they've reported a net profit of rupees 130.76 crores versus a loss of rupees 27.6 crores in Q3 of last year. We also have Raymond reporting its Q3 numbers. Revenue has gone up by around 41% on a year-on-year basis. EBITDA has also seen quite a strong surge of almost 76% over the previous year, and margins have gone up by 288 basis points, coming in at 14.5% in this quarter. Brigade Enterprises also quite a good set of numbers here. Revenue has gone up by almost 25%, and the net profit has seen a surge of more than 221% on a year-on-year basis. Shifting away from earnings though, there's also Granules India, which will be in focus since the company's facility in Visakhapatnam in India has received an EU GMP certification for APIs and finished dosages after a November 2024 audit by Hungary's health authority. And this facility manufactures oncology and non-oncology products as well. So positive news flow coming in for Granules India. Lastly, also keep your eye out on Whirlpool India, since Whirlpool Corporation, which is the parent entity in the US, has announced its intention to bring down its ownership in the Indian listed entity to approximately 20% by 20% by mid of 2025 by way of one or more market sales. And currently Whirlpool Corporation holds around 51% in Whirlpool India. So keep your eye out on all of these stocks today.
Well, Ria, lots of stocks to watch out for in today's trade. But while you're with us, also talk to us about L&T's preview, that the earnings preview. What's very interesting to me and what stands out to me is the order inflow number that's expected to come in at roughly 83,243 crores, which is a massive uptick, coming in on a 10% uptick on a year-on-year basis. Order book also expected to go up by 13% on a year-on-year basis. Overall, it's looking quite healthy. But tell us, what exactly is the street penciling in? What are the numbers that we can expect to see when it comes to their operational performance?
Well, yes, let's take a look at what the street is penciling in for this quarter for L&T. Quite a good set of numbers is expected. The revenue is expected to go up by around 17% on a year-on-year basis, and the EBITDA will also see an increase of around 18%. Net profit is expected to see a surge of around 28%. Coming to the margins, we're expecting a gradual increase in the core margins. For EBITDA margins, they will remain largely flat in this quarter at around 10.4%, and the net profit margin is expected to see a marginal increase to 5.82% in this quarter. We're also expecting execution growth to pick up in the core construction business, and the company will also continue benefiting from international spending and a potential revival in domestic spending as well. Now, as you said, a large order inflow is also likely in the second half of this year, specifically in the Middle East and across India as well. Some key monitorables to keep your eye out on as well: the domestic order pipeline, a margin performance and working capital cycle, and also lastly keep your eye out on a potential execution ramp up in the Saudi projects and the trend in the GCC order pipeline as well.
Lots to watch out for when it comes to earnings for L&T. Another Nifty 50 major FMCG company is going to be coming out with its numbers today. That's Tata Consumer. Muted set is what we're expecting on a consolidated year-on-year basis. Revenue is expected to go up by roughly 16%, penciled in to come in at 4,400 crore rupees. EBITDA is expected to see an uptick of roughly 4% at 594 crore rupees. Net profit is expected to go up by roughly 24% at 345 crores compared to roughly 280 crores this time last year. And EBITDA margin, however, this is a metric where we're expecting to see some pressure at 13.5% compared to 15%. Some key expectations that we are penciling in, hoping to see a 9.5 to 10% organic consolidated revenue growth, and higher growth from domestic business is expected to aid the top line. Higher tea cost is expected to hurt the Indian tea business, and price hike, remember that the company had undertaken to partly offset the tea inflation, might also be important to watch out for. Domestic tea business volumes are expected to grow by 3% on the back of this price hike, but however, on the flip side, international tea business is likely to post soft growth on a like-to-like basis. Now, salt business, we're expecting to see some growth because remember the company has undertaken a price hike of 2 rupees, and Tata Sampann and Soulful are likely to post strong growth. However, Nourishco is expected to be soft on a year-on-year basis. Important factors to watch out is going to be the management commentary on the domestic business, growth businesses, the margin outlook, as well as the rural-urban demand situation that they are seeing on ground. So watch out for Tata Consumer in today's trade.
Alright, then we'll definitely be keeping an eye on Tata Consumer, but time now to say goodbye on this edition of Market Cafe on ET Now. Stay tuned because the market is up next.